The UK property market is a confusing beast. And in this evening's live stream, I want to, as always, get through the mainstream headlines and try to understand what's actually going on. Because right now, if you were to land in a spaceship from outer space, open a copy of some reputable mainstream media publications, you would be looking at property prices are up, mortgage approvals are up, interest rates are down. And what does that mean in reality? It means we're in a reverse property crash, which is we should be in a crash, but somehow the data that's coming out are being interpreted as property actually going up. So this evening, we're going to cut through it and see what is actually happening. Good evening, everybody. Connor's on with Don't Believe the Guff. Yes, Connor, hello. How are we doing? We are live, so if you can see me and hear me, please give me a thumbs up. Please find something that you can write in the comment section. As always, I'm going to be getting through the slides where today I'm going to be explaining the recent data from the Nationwide, the recent data from the Zoopla. We're going to be looking at some interesting graphing and charting of the property market to see where it's going to be next, but zooming out and looking at what's going to be happening over the next 6 months. So without further ado, I will crack on because this is what the mainstream media is saying. Okay, for this reverse property crash. This is the Financial Times. Okay, you would think the Financial Times is the bastion of authority for reporting all stuff finance, money markets, properties. UK house prices beat forecasts to rise yet again in November. This is journalism, I would suggest, at its laziest. And this is journalism taking sound bites that have been put out from people who have an agenda and running with the story without actually really understanding what's going on. Because when we actually look at this, we can see that even though Nationwide have said, as you can see here, in November, we saw property prices in the UK go up by 0.2%. And I know I've covered this already. I put a post out on Friday. I was in Chester, everybody, so I didn't go live. I should have gone live on Friday and talked about it. We're live now. I'm back in the office. In actual fact, the raw data, the nominal house prices dropped by £1,000 between October and November, which is, I don't know, 0.4% or something like that. And if you actually dive into this and look at the seasonal adjustment that Nationwide used to come up from this actual real-time property price drop to somehow come up with this monthly change of 0.2%, they've added a seasonal adjustment, something like 2 to 3, in fact, it's 2.5 to 3 times more than the same period last year. And if you remember last year, we saw that mini budget. We saw things change considerably, and what I suspect they've done is they have taken that data and they've taken a seasonal adjustment, and they saw there was such a big change that they go, right, next year, we're going to compensate for that change by putting an even bigger seasonal adjustment on. So even though we've dropped £1,000 in property price, we're going to make it sound like it's gone up. Unbelievable, okay? So that was the headline figures on the Nationwide. And look, this is why I'm so passionate about this, this live stream, this show, this channel, because we're taking these mainstream media headlines, which I know are going to influence people, because right now, markets are sentiment driven and people can make wrong decisions based on the wrong sentiment that's out there being talked about in the mainstream media. People are a lot of people who are, don't spend all the time looking at this stuff, looking at data, pick up, and we have this thing called basically cognitive shortcuts. We have cognitive biases. We have a habit as human beings trying to make decisions based on the smallest amount of data possible because it shortcuts that. We haven't got time. People don't have time in their lives to go and crunch all the data every day and look at what's happening on a daily, weekly, monthly basis and understand all of the macroeconomic factors that are going towards house prices. So we open authoritative or trusted publications like the Financial Times and we look at the headline which says house prices is up again for the third month in a row, right? We go, we've troughed. Interest rates are coming down. Inflation is beaten. Now is the time to come back in. And this is where people get burnt, right? This is where people get really wrecked if you're kind of talking, shorter term crypto trading and that sort of stuff. So this is why I'm so passionate about crunching the numbers, looking at the data and putting it out there. So before I talk about the Nationwide HPI and what it's actually said and what we're actually seeing at the shop front, okay, I'm going to ask for your favor. This is the one favor I ever ask you. It is going to refer to my past self and my future self. And it's going to ask you how you can help me grow this and get this message to more people. I'll see you in 30 seconds. For those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Okay, so let's talk about some of the individual elements that are in this nationwide HPI. There's actually not a huge amount. It's a pretty scant report, if I'm honest. So we're going to start by looking at the path of interest rates, because this is the subject of a lot of discussion right now. Where are interest rates going to go into 2024, into 2025? And we have this perception, okay, that the property market or property values are directly related to interest rates. Now, of course, as interest rates are going up, right, all the commentators, myself included, is like interest rates act as gravity on property prices. So theoretically, with interest rates going up, it means people can afford to borrow less for the same amount of monthly payments. And if you can afford to borrow less for the same amount of monthly repayments, right, by definition, you can buy less or less value, and therefore property prices adjust accordingly. And theoretically, the same is going to happen when they start coming down again. But of course, nothing is ever as simple as that, because as they go up, you've got people on fixed rate, 2-year, 3-year, 5-year fixed rate deals, which we still do. We'll talk about that in a bit. And there's huge lag in the system. And when they come down, we've got to ask the question, why are they coming down in the first place? So when we look at this chart, this is the market implied path of bank rates, which is effectively what the market are predicting or expecting is going to happen over the next 1 year, 2 year, 3 year, 4 years. And you can see, I think the first thing, rather than focus too much on the actual lines themselves, here's the thing that I want to highlight to you. Just look at how different those lines are and how rapidly these change, okay? So we've got 4 different lines here showing 4 completely different trajectories from August, September, October, November. So they're monthly lines. In mid-August, we're looking at, potentially the market's potentially expecting us to go up to 6%. Now we think we've peaked, and when we get into sort of 4 years down the line, actually these three are pretty similar, sort of 4 to 4.2%. Now the markets are saying in 4 years they reckon 3.5%. So that's quite a big change. But my point is the markets are very reactive, okay? And a piece of data will come out and they'll completely reprice their expectation. Now, right now we have this this sort of standoff between the Bank of England and their narrative and the market saying, we don't believe you, we're calling your bluff. We think interest rates are going to be lower or come down quicker. And the main reason that we're seeing this change in narrative is because there's a lot more fears about the economy. Of course, everybody will say, look, we're just bringing it down because inflation's coming down. And of course, the reason interest rates are high is because inflation is high. So when inflation comes down, interest rates will want to come down. But interest rates will need to come down if the economy starts going into recession, right? Which a lot of people are saying is quite likely. I say quite likely, 50-50 chance. The Bank of England themselves said 50-50 chance in 2024 of a recession. However, okay, I still also want to bring your eyes to this figure down here, okay, this 3.5%. So right now, we've gone much more sort of dovish in terms of market expectation of where interest rates are going. They're saying in 4 years' time, Bank of England base rate is expected to be 3.5%, or that's what they're predicting. If we hit our inflation targets, which is sub 2%, and the bank is saying by then we might even be, 1.5%, even potentially negative for a little bit if it overshoots. But let's just say we're at 2%, and interest rates are sitting at 3.5%. We are sitting in a persistent environment with real-time positive interest rates, i.e. inflation-adjusted interest rates are positive. This is not something we've seen for the last 15 years. And when you crunch the numbers, right, and there's reams of really exciting reports that go through this and talk about the long-term effect of real-time interest rates on the property market. Go and look at the Peaked Interest Resolution Foundation report, which talks about their number crunching suggests that for every 1% change in real-time interest rates, okay, that is there persistently. They don't define what persistent is, whether it's, a year or 10 years, but for every 1% change in real-time interest rates, the property market will correct by up to 10%, which, by the way, is hugely more than their same analysis on supply-demand curve. So building 300,000 houses a year would suggest that might move the needle by up to 10% if we build, everything that we need in terms of flooding that with supply. So even if we settle here My expectation when you crunch the numbers and do the maths is that real house prices, so inflation adjusted house prices, will continue to drop for a significant amount of time. I've been saying for a long time now, I reckon 7 years. When you look at the last two drops, the last two recessions, real-time house prices peak to trough have been 7 years. So we could well be seeing the same again. Now, depending on what happens with nominal inflation and nominal wages, will then depend on what happens with nominal house prices. We could see inflation-adjusted house prices go down, nominal house prices go up slightly over the next 4 or 5 years. Anyway, real house prices, if you're an investor, right, is quite important because it's the real value of something you're holding. So that's the first thing to bear in mind. So even with these base rates falling over the next 4 years, they're still looking to settle expectation market-wise 3.5%. I've said I think 3.5% to 4.5% is where they'll end up settling in the medium term. Okay, so now let's translate that over to swap rates. So the swap rate is where mortgage companies actually price their mortgages off. So it's how banks lend to each other. It's effectively them hedging against each other. And what a swap rate does, so here's a graph of a 2-year swap and a 5-year swap. So the 2-year swap rate, 5-year swap rate. Effectively, that means the market is calculating that over that time period, that's the average interest rate. So if they're saying right now the 5-year swap rate is, let's just say 4%, because it's roughly 4% right now, over the next 5 years, it'll average 4%. So it could be much higher for the next year, then it could drop off significantly, right? We can see we've definitely got a downward trajectory of swap rates. However, this is going to find a base somewhere. And if we zoom out and go, sort of look at this graph here, we're still above 4%. We're just nudging 4% on the 5. Two year is going to be higher. There's only so far it can fall. And therefore, when people are talking about interest rates are falling, swap rates are falling, and mortgages are going to get much cheaper, how much cheaper, considering the amount of people that will be coming off much cheaper debt over the next 12 to 18 months. So that's another factor we need to take into consideration. This is actually a really interesting one. So talks about one of the key factors, and just so you can see, this is the UK house price to earnings ratio as per the Nationwide. So I would say Nationwide's HPI gives us slightly less in terms of average house prices. If you look at Halifax and ONS, it's, I would say, 5 to 10% higher in terms of the average house price. I don't know why that is, it's just how the model works. Therefore, because the Nationwide is lower, it's going to give a lower house price to earnings ratio. Now, if we zoom in here, this actually is extremely interesting in terms of understanding what's going to happen in 2024. And this is why I personally believe we're not going to go into meltdown unless we have recession. So we're not going to go in full-on property crisis unless the economy completely tanks. And this is what I've said all along. When you look at all those scenarios, when you look at that quantum of possibilities and what the probabilities are, we've got property market. Let's just go back on here. You've got property market goes back up, property market completely tanks. I've always been saying long and slow in terms of correction in nominal house prices. The main reason for that being, right, that we've been seeing strong wage growth. So when you look at that graph and you look at the strong wage growth, the house price to earnings ratio has come down significantly over the last year, and that is cushioning this thing. That's cushioning where we are. Okay, so we're actually, if I just take that off. Sorry, I'm trying to stay with the mic. I hope we're not having mic issues tonight, by the way. If we draw a line over here, we're pretty much hitting where we've been since we had the sort of, first recovery post 2008 financial crisis. Okay, we had a large drop, little bounce, kind of compression, and then we broke out of the compression, and then we kind of stayed level until 2019. Obviously 2019 went into 2020, we had COVID, spiked up, but we've now come straight back in terms of house price to earnings ratio to where we were pre-COVID. And that is without a doubt softening the landing of the housing market. Right now, as I keep saying, we don't have a huge amount of forced sellers for various reasons. I don't want to go into that now today, why we don't have forced sellers, but we do not have forced sellers right now. We still have more liquidity in the system. We still have a lot of people fixed on cheap rate debt. We still have forbearance in terms of mortgage companies with arrears. So this is softening, and why I think we'll continue the shallow, very shallow correction in nominal house prices, but we'll see a bigger real-time reduction in house prices. And then finally, let's look at the UK average house price. Again, this is Nationwide's data. And again, I want to zoom in here to the top. Now, I don't know what people quantify a house price. A lot of people are out there going, we need a house price crash. We need a house price crash, or we want it, because that's, kind of how our psyche is geared. And then every month we're like, ooh, prices are 0.2% up. what's going on? This is defying gravity. And then the next month it's 0.3% down. We're like, they're crashing. And then, every month by month is irrelevant. We need to look at the patterns. And if we look at a pattern here, right, we've obviously had a post-pandemic boom. We've had our initial correction. Would potentially say the gradient to that is almost a crash, right? So that post-mini budget gave us a flash crash in the property market. We've had our bounce. And we've kind of found a floor for the moment. But if there's any purists in terms of charts here, you could argue we've got some form of compression pattern here. And, I'm not a stock trader. I don't do crypto, any of that sort of stuff. But I know enough about it to understand that patience is the key. You have to sometimes just sit on the sidelines and wait and see what's happening for a prolonged period of time. Because sometimes markets do just go like that and they sort of deviate around the norm. And, you can have your rising wedge or your falling pennant or whatever it is. But when you're seeing these fairly boring markets, which, if I'm trying to be honest, we're in a boring phase of the market because the market is frozen. Transactions have fallen off a cliff. Everybody is pretty much waiting and sitting on their hands to see what's going to happen and go on in the property market. Because there aren't forced sellers to force the market down, we're pretty much just sideways and deviating around a mean at the moment. And I would say that compression looks like it's compressing, or that pattern looks like it's compressing. At some point, right? At some point it will break out. I do not know if the chart dynamics of the property markets, because there's so much lag and so much inertia in it compared to stock shares, cryptos, things like that. I don't know if you can use the same patterns. Maybe somebody on here knows and would be able to sort of help me out with that. But in my sort of little pea brain, as I try and analyze this, I do go, right, we've got a sideways market compressing, and at some point it's either going to spill out down there or we're going to go back into a sort of, ascending at some point. Now, most people in the middle are saying we're going to probably, let's just go off like this. We're going to carry on in this for a while. Now, we could say, right, that could be to the end of 2024. You look at Rightmove, you look at Zoopla, you look at OBR, you look at pretty much anybody, you look at Lloyd's, they're all saying next year probably expecting 3%, 3.5% drop in nominal terms for house prices, which is not particularly here or there, right? It's fairly sideways over a year. So we could see these fluctuations going into 2024. Now we could see, of course, something which increases the flow of supply, and then we go down here, or the supply stays contracted, all right, and then we avoid recession, and we do see interest rates come down and people's affordability go back up because there's those nominal wages have gone up. We do see this. I think this is the most unlikely from my point of view in terms of probabilities, but it is a possibility. Okay, so you can't really make a lot of predictions past the end of 2024 because it's so far away. You don't know what's going to be going on and happening. So that effectively is what the Nationwide is telling us right now. So these figures of property prices are up. Just ignore them. Just phase that mainstream stuff out. Understand the data. Prices are down. They're not 0.2% up. They are actually physically down about 0.4%. I seen somebody said how are seasonal adjustments calculated. I've actually got no idea. If anybody could help me with how they work out seasonal adjustments, I'd love to know. My personal view is they're making it up, right? Somebody somewhere is just making this up based on some data set they're seeing going, let's put this seasonal adjustment on. And inevitably, when you're using data, they're probably comparing to past data sets. So they've probably seen this huge spike or this huge variance in 2022 with the mini budget, and that's crept into this data. I don't think people do this on purpose, by the way. I don't think it's somebody sitting Nationwide going, let's con the whole world, the whole country. But I do think there are agendas at play, right? Because Nationwide is a lender. They want people to lend. They want eyes on what they're talking about. And so headlines get eyes on get them business. And it's a bit of a competitive market for mortgage lending now. Right, let's talk about mortgages then, neatly segueing onto mortgages. Because the other thing that I've started to see a lot of people talk about is mortgage approvals are up in the last month of data, which I believe is October's rather than November's. And we're going, wow, okay, right. Is this the property market unfreezing? Are we thawing right now? And if we're unfreezing and thawing, is that because there's forced sellers coming in and so therefore they must sell? Or is it because we've got confidence back in? And actually, let's just go back to this. Confidence goes everywhere, mainstream media, people, and it's very much driven by sentiment. So, if you see anything moving very quickly, like when the swap rates were going up post mini budget, confidence was shot. If you compare this, right, this period here to house prices, let's go to the house price graph, right, that period coincides with this big drop here, okay? Then we see confidence return, Sorry about that. Let me just go back to the swap rates. We see confidence return in the market when the swap rates come down. The swap rates came down after that mini budget because they're not just, when they spike quickly, they're going to come down again at some point, probably quite quickly. Confidence comes back in and we see a bounce in the market, okay? Markets are perception driven. We can see that, the bounce. Then we see, we bounce up and then the confidence gets shot again. Swap rates spike up when that inflation's stuck, over the summer, goes down. So we're very, very perception driven as a species, if you like. I'm not going to go into the deep psychology of it now. So let's talk about these increase in mortgage approvals to understand what's actually going on with the mortgage approvals. Now, when you look at it like this, okay, in this graph, this is the year bar chart of mortgage approvals. It looks like we've got a fairly substantial increase in mortgage lending. Actually, if you look at the bottom, so this is from Trading Economics, website Trading Economics. Down here, what they do at the bottom, I'm just going to highlight it at the bottom, is they give the previous, which is that one there, 43,675, and then the consensus is kind of a merged figure of various commentators or data analyzers thinking where it's going to go to. And then we've got the Trading Economics forecast. So they thought it was going to be 42. So Trading Economics thought it was going to come down, 42,000. The actual was 47,000. Oh, I've just gone over the 47. So the actual was 47,000. So quite a lot more. And look at that bar chart. It looks like it's been quite a decent amount of increase. Okay, let's actually take this back. Now let's zoom out and let's go line chart and let's zoom out for the last 20 years or 25 years. I think this is the 25-year view. Okay. Look at the mortgage approvals and let's just zoom in where we are now, and all of that sort of commentator narrative of mortgage approvals are up. It's that little teeny tiny uptick there. Okay, it's that bit there, nothing. Let's zoom out again. It's barely even registering. Yes, in terms of percentages from 42 or 43 to 47, you could argue, look, it's a 10% increase, but it's from such a low base. And that's the thing. Because we've got such a small data set at the moment and historically unusual data sets, none of the usual forecasting models are really working because they don't have enough data. And so anything can skew, any movement can skew the data very quickly. And I believe that's what we're seeing here. For me, we've got to look at those patterns, right? What we're seeing here is not a pattern of recovery. It's not a pattern of people flooding back into the market and getting loads of mortgages. We've seen a very small uptick in terms of real numbers compared to this historics. And if you look at historical mortgage approvals, right, since 2008, and it probably got back to the 60,000 a month level. What's that, about 2013? And since 2013, bar COVID, right, we've kind of been 60 to 80 band. Yes, then after the mini budget, we saw this massive, massive drop off, but we've never really recovered from it. We're still sitting there low. And again, if we go historically, 40,000, there's only one time in history it's been below 40,000, and that was at the very depths of the financial crisis of 2008. Okay, so we're still at a hugely low amount of of mortgage lending. And actually, I haven't put it in. That's really frustrating. I had a slide, I don't know if it's in anywhere else. No, I had a slide which actually shows the next chart of these on Trading Economics forecast, which is the net amount of borrowing that we have on a month-by-month basis. So this is the net amount when you aggregate the amount of mortgages people have taken out and the amount of mortgages people have paid back. And for the second month in a row, we are at a net negative, which means the UK has paid back more of their mortgages than they've drawn. So the month before, so September, was about, off the top of my head, 0.9 billion. This month was a lot less. I think it's 0.05 billion in terms of net, minus 0.05 billion in terms of net mortgage lending. But that's 2 months in a row. And when I look back through the chart, other than the COVID pandemic, where people were given a lot of money and a lot of people just paid mortgages off with that money, I can't see many other times where we've had 2 consecutive months of net reduction in mortgage lending, which means people are paying their mortgages off, right? They need to clear the mortgages, and they're trying to clear their mortgages to reduce those interest rates as that interest rate burden gets heavier. So that to me is not suddenly loads of people going out taking loads of debt on and mortgages, right? Interest rates have come down a little bit for mortgages, but they're still historically for the last 15 years, massively high compared to house prices. Okay, so I thought that was interesting to share, by the way, because I've heard a lot of people talk about, more people taking out mortgages. So let's look at Zoopla. I mentioned this very quickly last week. I just want to go through a few of the stats from Zoopla, and if you haven't looked at the Zoopla HPI, I really actually like the model and the data that Zoopla HPI gives. It's less of a house price index, more of a forward forecasting model, and I think that's really, really good in terms of trying to get that crystal ball about where we're going. By the way, in terms of crystal ball and predicting where the property market's going, if anybody is, I know on this channel we get people who are homeowners, home movers, but also property investors, and specifically a lot of the content, a lot of the training I do is for property investors. I help people buy investment grade property, high cash flowing property. Right now there is so much opportunity, but every time I log on social media, I see people going, look, there's no deals out there, there's no stock, there's no deal flow, we can't find things, which I think is curious, because I'm actually in the accumulation phase right now in my own portfolio and been buying since January, re-entered the market January this year. And there are some fantastic opportunities and some fantastic deals out there. And I was chatting to a mate of mine, Nick Thorpe, who's ex-military as well. I'm ex-RAF, he's ex-army. He's the same, so he's also buying and sourcing for overseas investors. And we thought, look, if people aren't finding deals, there's obviously something wrong. People are obviously looking in the wrong place or using outdated strategies. So we've decided to put on a brand new implementation program, if you like. And if I just grab the slide for it, it's called the Deal Blitz. I've not done anything like this for about 6 years in the property market. So for those who are interested, it's going to be an 8-week full-on immersive implementation program where we're going to walk you through building your deal machine to find high cash flowing property deals in the current market that actually stack with high interest rates. Now, if that's something you're interested in, we've just opened up the early bird list, which is effectively sign up, you get on the early bird list, you get info about what's going to happen, and there's an insane offer because it's the first time we've run it. So anytime I run a new program, basically let the first 10 to 15 people come in with a massive discount and a huge amount of value add in there. So please, if you're interested in that, go to robstewartglobal.com/deal-reg. I'll pin it, that link in the comments as well, and get on that early bird list and explain the next steps and how the thing is going to work. So hopefully, if you're into property and maybe you've been wanting to work with me for the last 6 months or so, but the sort of year-long mentorship's a bit out of the price range, this will be the perfect first step for you to get involved in. So I'll pin that in. Right, let's look at what Zoopla says. So here is the Zoopla data. Now, we are still seeing, well, I talked about this last week. I think I maybe got a little bit, maybe I did Richard O'Donnell from Zoopla a bit of disservice, getting a little bit hot under the collar about the fact that they've removed the second set of bar charts that they've always used on this graph, been up north over the weekend. The black is basically the average for the last 5 years, and the purple they've been using is versus 2022. So for this month alone, they've removed the black bar charts, which are comparing it to the last 5 years, because obviously that would give a much more representative example of what's actually going on. But because we're now comparing it to this time last year, this is post mini budget sort of meltdown, if you like. And so it's easy to manipulate data by comparing it to periods you want to compare it with. So they're saying, look, buyer demand's up. Whoa, look at that. Sales agreed is up 15%. So look, we're seeing sales go up 15%. We're seeing mortgage approvals go up. Everything's great. The property market's booming again. We've reversed, right? No, this is compared to November last year. Literally post mini budget, when all those house sales fell through. I know, because mine was one of them at the time. Nobody wanted to buy. You saw that massive dip. Okay, this is a manipulated piece of data analysis if ever I've seen one. You want to see these graphs related to the proper period, which is a rolling 5-year period, right? To get a real analysis of what's going on. So let's just get rid of all of that. What is obvious, right, is we are seeing more stock on the market. This is true. However, we are still seeing, minus 1% flow of new supply. So implies to me, because the supply is contracting, actually this 34% is more than it was on the previous month. Supply is contracting, more stuff is actually on, which means less things are selling, or properties are coming back on the market, so the sales have fallen through. When I look at some of the prop tech that I use, I'm seeing huge amounts of properties that are back on the market, right? That is not a good thing. So we're seeing huge amounts of price reductions on the shop floor, huge amounts of properties that are sold subject to contract, then come back on, and that is not a good thing for the property market. So interestingly, right, if we actually look at the supply, we can see a very clear trend, and I love trends. of increasing stock. So number of homes for sale reached 6 high. This is a graph of homes per sale per estate agent. I think it's really important to try and see interpret data in all of the ways it could be interpreted. Because you could look at this and go, look, we got properties flooding onto the market, clear trend of more stock per agent. That's true. It could be a trend of stock sticking or things going back on. It could also be a trend of agents going under, agents struggling, and therefore the agents that are left. I have no idea, by the way. I've not looked to see the number of agents, actual estate agents, if that's contracted at all over the last 6 months, 6 to 12 months. I'd imagine in periods like this, I know just anecdotally, the house I just moved from, the landlord was looking to sell it, and he listed it with quite a well-known premium estate agency, which went out of business, I think 3 weeks after he listed it, and then he went for it with a local agent. So that is purely anecdotally, right? I might try and look for if we've had a shrink or reduction amount of agents over the last 6 months, because that will also increase stock per agent, and that's another reason. So we need to understand all of these reasons. But without a doubt, we are seeing a reversal in trend and more stock on the market. And then this is discounts from asking price. And we've got an average of 18,000 per unit per house. Now, let me think. Somebody shout out to me if you can remember off the top of your head what the average house price is in the UK ONS, not the nationwide, because I know we just looked at the nationwide. Let's just get an idea from the nationwide. I think it's about 270,000, the average. So the nationwide is at 260 odd. I think UK ONS is 270, right? 18,000 on a 270 is 6-7%. So on average, you're seeing 6-7% discount on properties, and that's average. Don't forget, there are going to be some areas where demand's going to be higher, first-time buyer markets, cheaper ends of the markets where you're going to have less requirement for negotiation. So on average, it's probably 5-6%, but I'd imagine there are going to be some subtypes of property that are going to be seeing significantly more than that. If we look at London and the Southeast, minus 6.1% there. Obviously, what we got, rest of UK, minus 4.8%. So it's no surprise, okay, that London and the Southeast with the higher value properties are seeing more discounts. But when you look at the data, okay, media headlines, property prices up, interest rates coming down, perceptions going up, mortgage approvals going up. It sounds rosy. When you look at it, you see actually supply per agent going up. Supply is going up. Asking price reductions or sales agreed from asking prices are coming down more significantly. People having to reprice more significantly. Mortgage transactions are still really low. And yes, swap rates are coming down and interest rates are coming down, but they're not crashing down. Okay, we're not suddenly back at 2% in terms of debt. And this is why Zoopla, on their overview, are saying, without a doubt, house prices down, mortgage rates to follow. But you see sellers are offering, if I just zoom in on that, sellers are offering their biggest discounts in 5 years, with 1 in 4 offering 10% off the asking price, putting buyers in a strong negotiating position. And we know when the portals and the HPIs are talking about this, we are definitely in a buyer's market and sellers are struggling, right? Now let's take that and go into 2024 and see where we are, because I'm going to talk about it again. I talk about it every time. I'm talking about the gap, right? The gap is going to get bigger in 2024. And what do I mean by the gap? There are 800,000 homeowners with fixed rate deals ending in 2023, with a further 1.6 million in 2024. Another 1.6 million. So all of this time, with all the interest rates going up, there's still been millions of people, millions of mortgage holders protected by it because they're on cheap fixed rate debt. People who locked in 5-year cheap rate at the end of 2021 are probably laughing right now, but even that is going to expire at some point. Every year, more people are coming off, or every month, every week, more people are coming off the cheap fixed rate debt. So whilst everybody talks about, swap rates coming down 0.4% or 0.3% or 0.5%, and the average mortgage rate coming down 0.25% or something like that, every month you've got 120,000 people coming off sub 2% mortgages going on to 5% mortgages, right? And it's going up 2, 3, 3.5, maybe even 4% month on, from 1 month to the next. And that is going to be affecting way more people who are coming from cheap to expensive than the people who are benefiting from the slight drop in swap rates. Okay, if we look at the average fixed rate mortgage rates for home buyers right now, I just grabbed this morning. This is the latest set of data I could find. Different mortgage products, different interest rate. I do love it when graphs have a baseline like this one. The baseline is 4%. Okay, because it makes it look like actually interest rates are really cheap when we come down. Oh, sorry, I need to put this on. It makes it look like interest rates are really cheap if you use this at the bottom of the graph, whereas that's actually 4%. So we topped out, right? If you look at that in this summer, we topped out pretty high. So those people who were fixing in the summer were fixing on high, but I suspect not a lot of people were fixing at those high rates. I suspect most people were sitting on standard variable rates, hoping for those mortgage rates to come down, which of course, the mortgage rates are now coming down so people can fix at a more reasonable rate. I'll be fascinated to see how many people actually fixed at the peak at 7% on a 2-year fix. I'll be fascinated to see that data. But even now, right, the average, and this is the average, because I see a lot of commentators jump out onto a YouTube video and go, this is what you can get right now, right? Like, I don't know, X bank is offering 3.5% on a 5-year fix. This is amazing. But they don't talk about the fact it's got a 5% or a 7% product fee, right? And the fees. And when you add all of that, not a 5-year fix, a 2-year fix. That was the one. It's like 3.5% on 2-year fix, or something like a 5% or 7% fee, or something ridiculous. That when you add the fees in, it's the same. But of course, you're putting the fees in, it gets added to the mortgage, and the banks are just laughing. They're like, oh, they're going to put more debt in, and then they're going to charge. We'll charge interest on the debt that we've just made up because we've just made this hypothetical $7,000 fee or whatever it is. We'll add it to the mortgage, and we'll charge interest on that as well, and we'll laugh all the way to our own bank, right? Because we con them into this thing. These things might work for somebody depending on your situation, by the way. I'm not saying it's all bad, but let's not beat around the bush. We're not sitting in an interest rate environment that's 3.5% right now. Averages, so we've got the average here, the very lowest, and that is a 60% 5-year fix, is still above 4.5%, the average, right? 2-year fixes are still just nudging below 6% for a 95% 2-year fix. And this is today's data, just below 6%. So all these people, right, yes, we might have got 6 months ago been 7%, now we're 6.5% or whatever. Nothing compared to all the people coming off the cheap rate debt. So this gap is getting bigger. And as the gap gets bigger, we can afford less. Okay, so this is what it looks like when your mortgage goes from 2.5% to 5%, right? You can afford this much less. So if your budget, let's just say if you can afford £2,000 a month on your mortgage, if you're on 2.5%, you could get a £442,000 mortgage. If you're on a 5%, you can get a 338. It's over £100,000 difference. So this has to long-term reset property prices unless the mortgage rates start coming down pretty quickly, which, let's face it, they're not. Good. So my point. What points am I making today? I talked about the reverse property crash because I feel there's a lot of mainstream sentiment that we've hit the bottom. Mortgage rates are on their way down quickly. Inflation's beaten. The property market is so strong, it's so resilient, and it's going to be bouncing back up. It might well do. That might still happen. Okay, it is on the quantum of possibilities. I think it's a low probability anytime soon. As we put all these figures out there that imply the property market is going up again, actually the reverse is happening, right? You can't say it's going up when it's still going down. It is still going down. And I'll always come back to this graph, right? If anybody cares about what the house is actually worth in real terms, this is the only one you need to care about. This is the real inflation-adjusted house price graph. This is nationwide house price graph. This other gap, this is the second gap, right? This is diverging every single month from the red trend line. Houses are getting more and more affordable. If you look at that, this is probably, when you look at deviation from the trend line, I would suspect we are now more than that, which is the largest deviation in trend line since this started, which is 1985. Okay, there's only been 3 periods where we've been behind, period 1 here, very small period 2, because in the 2000, here, this was, the biggest bubble. In terms of real time, when they crashed, they kind of actually reset a little bit to the trend line, and then they followed. You look at this here, they reset to the trend line, right? But if you take this box here, we've been going that direction, going under the trend line. We've been under it actually since 2016. And even the boom that we had post-COVID had still not brought real house prices up back to the trend line. And now we're crashing, from a position that started below it. So when you look at property as a store of wealth, compare it to things like, gold, precious metals, stuff like that, it is very cheap right now. It's very, very affordable. And it's also worth noting that every time we've hit a bottom of this trend line, like all markets do in a free market economy, I don't know if we'll ever see this again in our lifetimes. This particular, that is quite an extraordinary 97 to 2007. That's quite an extraordinary 10 years worth of price growth. But this is not going to carry on going down here forever with the trend line, going up here. At some point, with a free market economy, property will be cheap. I think it's there right now. I think we're in accumulation phase. I think the gap is going to widen next year, but this is why I still don't think we're going to see massive nominal house price crash. I think we're going to see a sideways, if slightly correcting down nominal house prices, with the real house prices diverging a bit more, probably until 28, 29. And then we will see that reversal in real house prices. There we go. That's what I've got for you this evening, my friends. Hope that's good, team. Give me a thumbs up if there was some useful stuff in there. And we learned something this evening. That'd be good. Let's go see if there's any comments or questions. Richard, let me just put that on, Richard. Just seen another vid in Nationwide, Halifax, Rightmove and ONS all showed that over 23, the price is actually flatlining. There we go, flatlining. Just crazy and contributed to the standoff. So it is, right? We're frozen. The whole thing's frozen. Any flatlining market in a free market economy will go one way or the other at some point. It will not flatline forever. There will be a capitulation or a breakout up. The problem with property is it just happens so slowly in such lag. There we go. Lovely jubbly. Any other questions? If GDP starts the same next month, we're officially in a recession. Let me just get that up. I just want to say something on GDP, Alex. So I'm glad you brought GDP up. Again, data, fantastic thing to manipulate data. GDP, technically we are not in recession because GDP is doing its zigzagging, jagged sort of sawtooth, and it's not going one direction or the other. It's kind of meaning very slightly up and a bit more up if you believe Blue Book 23 and the recalibration with a different set of yardsticks to make it look better. What GDP does not show us is GDP per person. And I had somebody put a comment on one of the videos the other day, which is something that I've covered a month ago, something like that. When you look at GDP per person in the UK, it's dropping. It's dropped a fairly decent amount. So we do have net population increase. And I think I'll give a little sneak preview to something I'm working on at the moment, and that's Resolution Foundation in conjunction with some other organisations have just released a fascinating, very detailed, in-depth 350 page report, which I'm slowly chewing my way through at the moment, about where we are in Britain, where our economy is, how we fare against all of our peers. And most importantly, why we're not really doing very well when you look at it objectively, and how there seems to be a complete lack. Well, we are in stagnation as a country, complete lack of investment, public and private, into public and private companies, and why that is and how we can fix it. So I think that's going to be a really interesting thing to look at and take into how we link that into the property market and how we link it into business as a whole. You'll know that I'm a business owner as well as a property investor. So seeing where the opportunity is going into the next decade or the next 10, 15 years of this economy. But right now, we're not doing very well. GDP per head dropping. We are stagnating. We are real terms poorer than we were sort of 10 years ago. So there's some interesting stuff to crunch in there. Lovely. Oh, sorry, we've got mine for some more questions here. So let me get that off, Alex. I hope that was useful talk. But thanks for that comment. AM, bear in mind that not everybody can access the best rates, especially first-time buyers, 100%. So the best rates are always to existing customers with low loan to value. Mohammed, I'm glad. How are you doing, Mohammed? Hope you're very well. John, I've just had purchase agreed at 208, discounted by 30k. Motivated sellers are out there. I've noticed locally an uptick in sales in lower end of market for rental properties. Yeah, so let's get that on, John. As you mention it, let's back that up, that anecdotal observation with some real hard and fast evidence. which demonstrates where the opportunity is. And by the way, congratulations, John, on your purchase. I don't know anything else other than the fact you got a discount, so that's great. Hopefully it's a good deal that you're very happy with, and it's going to yield nicely for you as well. Or I don't know what your plans are with it. Let me know what your plans are with it. I'm just trying to find the arrears data. I may have deleted it, sadly. I'm having to go through my slides and clear them up every so often now, because it's getting quite memory heavy having like a 400 slide deck with all these graphics in it. Here we go. Right. John, I'm going to have to take your comment off very quickly so we can see it. Okay. All I want you to look at, team, here is the teal blue line, right? This graph is arrears for residential mortgages, and the teal blue line is mortgages that in the arrears bracket 2.5% to 5%. So the first time they start reporting on the arrears data is when somebody hits 2.5% arrears of the total loan outstanding, which if you've got a 75% mortgage on your property is about 5.5 months worth of missed payment. So a fair amount, to be honest. Residential, we're seeing an uptick, right? You can see the uptick. Not massive, but it's an uptick. And year on year, it is 36%, quarter on quarter, 10%. If we look at buy-to-let, that is the buy-to-let sector, where we can see basically what appears to be pretty much a cumulative curve now of buy-to-let mortgages in arrears. That's going up very quickly. And now we're seeing the next ones below as well starting to tick up as well. So these are very serious. So this is 5 to 7.5%. So we're now starting to filter through. And if we look at year on year, that's 174% year on year. And I mean, 33% quarter on quarter. People going into serious arrears, which I'll say is 5 to 7.5% of the balance in arrears is quite a lot. That's 48% quarter on quarter. Almost 50% quarter on quarter, huge amount. All the properties that I'm buying at the moment, and this year so far, we've either bought or have in legals £1.4 million worth of property. It's all from baby boomer landlords who are getting out the market because they just don't want to be in it anymore. And therefore they are very willing to sell at a price that facilitates a yield-based, a sale for me. That means I can do whatever I need to do, add the value, recycle out to get a very high return on whatever capital I leave in, even at. And we're doing everything now at an 8% interest rate. I think that's if anybody's in the investment space, I model all of my lending on an 8% interest rate right now with where the base rate is, and would forecast that will be there for at least the next year. And then if it starts coming down, brilliant, right? The margins increase. But sorry, I got sidetracked there. So it's all coming from these baby boomer landlords who have had significant equity uplift in their properties over the last 20, 30 years from passive gains. So actually, they don't, of course they care, but it's not so relevant for them if they are shaving 10, 15, 20% off where it was a year and a half ago just to get rid now, because all the other things that are weighing down them, tenant or renters reform bill, section 24, minimum energy efficiency standards, although that's been kicked down the road a little bit. A lot of people in their 60s, 70s, 80s, like, why do I need any of this anymore when I can just sell, get the equity, and that's going to keep me going for the rest of my life? Boom. So that's where the opportunity is, without a doubt. Neely, as an investor, I'm looking for yield to determine value. Neely, how's it going with Greggs? Have you got them in yet? Have they started doing some work? Rob, mortgage. Oh gosh, wow! I'm going to put that on. Rob, very sorry to hear that. Mortgage payments just went from 443 to 1,545. Wow, is that on an investment property or is that on your personal property, Rob? That's a significant increase, isn't it? I'm sorry to hear that, and I hope that is something that we can get through over however long we sit on Table Mountain now, because I don't know, the bank might just be bluffing, right, to stop people going out and spending loads with their narrative the interest rates are going to be high for long. Maybe the markets are right. I've always said I thought they might start coming down August next year. When we look at the inflation table and we look at where it's probably going to go over the next 6 months, the next quarter I think is going to be super sticky because there wasn't much in December 22, January, February 23. So whatever we have now is not going to reduce it by much. And then we start seeing it come down in the next quarter. So March, April, May 22, we see there's a decent amount of inflation that was in there in that quarter in 23, which is going to drop out the data set, which will probably see us get down again. And that's when we might see, potentially be the first time you might see some interest rates coming down. But banks saying that's not going to happen. So I'm sorry about that, Rob. Bluefish. would you say that the climate for first-time buyers will be better end of 24 than now? Extremely subjective answer to that, Bluefish, is with everything, with the trends I'm looking at and the current data and interest rate projection, I would say yes, 100%. I think if I was a first-time buyer, by the way, everything I say on this channel is entirely subjective. I'm not an advisor, financial advisor, accountant, mortgage broker, anything like that. I'm somebody who grows my own portfolio, has my own portfolio, buys businesses, and helps others with their property investment journey. So I'd never advise on personal or residential properties, because I think it's different set of circumstances when it's your own home, and actually cost, what you're paying on a monthly basis might not be the main factor that you need to worry about. However, I rent. I'm in rental. I love rental. I enjoy the flexibility of rental. I enjoy not having to pay maintenance on my house, which of course is a liability if you own the house yourself. And the reason, that I'm in rental is because I can afford to live in a much nicer place than if I was buying. Don't have to pay things like stamp duty. When you buy a house, for the first 10 years, you're pretty much just renting it anyway off the bank. And if you don't pay, they'll just come and take it away anyway, if you're buying with a mortgage. And rather than put all my money into a deposit for my own house, I invest it. And then the yields, the returns that come from those investments pay for the rent. So I still own property. It's still either going down in value, which it might be right now, but actually it's probably going up because I'm very much in, the way I buy is depressed valuation, add the value. So generally it goes up, and because rents are going up and pretty much all my stuff is on commercial valuations, with the rents going up, that actually increases the value. So that bricks and mortar HPIs are fairly irrelevant. Rents are going up a lot, and that means it's covering, obviously our rents aren't cheap, but the portfolio covers that and a lot more. So that's how I look at it. If I was going to be buying first time buyer, I'd be waiting another year or so, because we might see some reduction in mortgage costs. We'll definitely, going into 2024, summer and beyond, see more, I would say, more motivation, more for sellers, and therefore there could be much better opportunities for you out there. I think people think, we need to jump in because we're going to miss the boat. Property is so slow. It's slow, so glacial. When the market does trough, it's not suddenly going to ping back up. It might do, but I think it's very, very unlikely it'll ping back up. I suspect we'll trough and flatline for quite a long time, as I said. So I don't think you need to worry about missing the boat or anything like that. This also depends on where you're living. There are places in the UK where it's going to be cheaper to get an 8% mortgage, or 6%. I'm talking commercial style investment mortgages. If you're on a residential, getting a 4.5% mortgage versus renting, because renting, the cost of rent has gone up so much, and there's such a lack of units. So there's so many factors when you're talking about your personal place. But there we go. That's it. A lot of it depends on your circumstances, Bluefish. But that's what I would say. Hopefully that helps. Neely, 7% from guilt. Yeah, it's true. So, it's an interesting, I'm going to put that on from Neely. I think it's a really interesting point. And this is, by the way, why commercial property valuation, and let me just, what time is it, by the way? Sorry, I do have to pop off soon. So I'll finish Neely, answering Neely's, and then I'll probably have to pop off. I'm just trying to find, there we go, that's what I'm looking for. By the way, team, this sort of Q&A at the end of the sessions, is this something that is useful to you? Do we, is this a good thing to carry on doing, or is it a bit of a waste of time? Let me know. Put something in the comments. Talked about this last week. This is the value of commercial property, and commercial property has had a horrific readjustment based on the fact that, sorry, Neely, I'm going to have to take your comment off because otherwise people can't see it. Based on the fact that commercial property is valued on a yield basis, right? And yields are inverse to value. So if you can just stick your money in a complete safe haven like gilts, right, or treasuries or whatever, and you're at 6-7%, why would you stick your money in anything else other than to get a much higher return on that, right? So if I can stick, and it's completely risk-free, it's completely passive, right? There is nothing more passive than sticking it in something like a bond, and it's going to come back, right? If I was going to then mess around with property or buy property, I want to be getting way more than that 7% to justify the risk profile and the effort that needs. Oh, sorry, I didn't take it off nearly. That goes into buying that property. Okay, so therefore yields go up on anything that's valued on yields go up. Anything that's valued on a yield basis, i.e. commercial property, values go down. Same with bonds, right? Yields go up on bonds, value goes down. Yields go up on property, values goes down, which is why we've seen commercial property go boom, right? Because nobody will buy at where they used to buy when they just go and stick their money in a bond. And that's why I know what Neely is saying is, why would I get involved in property until it gets to 10 to 12% property yields? And I completely agree with that, which is why you can buy some super discounted opportunities right now, add some significant value, recycle it out, and then get a much higher return on your capital. By the way, again, anecdotal story, sort of narrative. So this place has been in Chester. I mentioned it last week. Mixed use building, 4 flats with retail below, restaurant. Got heads of terms for a sushi franchise. Actually, looks like a good business. So we're currently getting it valued through Lloyd's for a portfolio refinance as we're buying another property. And basically what we're doing is we are leveraging against this one because we own it in cash, leveraging against this one to borrow some money to go and buy the other one, which means we have to put very little deposit down. So we're buying this other one for 908,000 and we only have to put a £100,000 deposit plus stamp duty. So we can get in with a much lower amount of upfront money because we're leveraging against what we already have. Right. So anyway, I met the valuers there on Friday and asked them how they were valuing, what sort of yields they were looking at. And Neely, you'll find this interesting. I was actually quite surprised. So mixed use building, he said he would probably, now this is city centre Chester, probably around 9% for the commercial, and he said 6 to 6.5% for the residential, which I found incredible, incredibly bullish. I mean, by the way, fantastic in terms of getting valuation. Doesn't matter because all I'm doing is leveraging against the purchase price of the property and what I put into it. Lloyd's will not let us pull loads out. But it's still nice to see somebody saying, oh, look, it's not all doom and gloom and this is worth, a 12%, 14% yield. It was strong. It was encouraging to see, that bullish sort of valuation on the property. Obviously, I'll wait to see the report, but I think that's interesting. Right. Cool. Mark says, sorry, last question, just to explain personal circumstances. Mark says, what do you mean been up north at the weekend? So Mark, just some explanation on that. So I lived in Chester for 15 years of my life. So when I left the Air Force I was in the RAF. I was based in Scotland flying Tornadoes. I came down to RAF Valley on Anglesey to train people to fly the Hawk, tactics and weapons instructor on the Hawk, which is what the Red Arrows fly. And I bought a house in Chester in 2008. So that's 15 years ago. And basically stayed there ever since. So when I left the Air Force in 2011, I carried on living in Chester and I built my business in Chester. Various personal reasons mean I moved from Chester last year down to Winchester. My business is scaffold business. My properties and my children are all in the northwest of England. So every 2 weeks I go from Winchester to Chester to basically be with my kids and spend some time with my businesses and my property portfolio and do all that sort of niff-naff and admin and triv. And that's where I still buy. So I'm still buying now. So I don't buy down south because I cannot get the yields down south as a momentum and a cash flow investor who invests for yield. It's way more difficult to find it in Winchester and the surrounding areas versus other areas a little bit further north than sort of M4. Generally, Birmingham and above is the best place. But also, I've been investing 15 years. So I know Chester and the surrounding areas like the back of my hand. So that's my stomping ground. Hope that gives you a little insight. There we go. Perfect. All right, team. It's been an hour. It's been a pleasure. I'm going to sign off. Remember, if you're new to the channel and you're watching it for the first time, please do subscribe. It really helps. We're on our way up to 3,500. Look, my aim is 5,000 within a year, which would be 5 times what the original target was, which is to hit 1,000 in a year. Look, I've got so many plans for this going forward. So many things I want to do. Want to help people in property. Want to help people just perform and up their game and improve. And we've got lots of things in the pipeline. So really appreciate everybody tuning in and creating this family and team that we've got here on the channel. It's been an absolute pleasure. Okay, have a good week. It's only Monday. We've got 4 days to go, but don't work too hard. It is Christmas period. It's December. We can now start talking about it. And it's my birthday on Friday, so I'll be taking a few days off. I'll see you soon, though.